Hi, I'm Allie Holcomb. I'm the operations specialist here at Southeast Financial Services. Here's a video where John and Daniel are going to talk about rising interest rates and inflation. We hope you enjoy and we welcome your feedback.
Pretty clear that we're in some disruptive times where there's a major volatility on all fronts in the investment world. This has been caused and then exacerbated by both geopolitical issues as well as inflation, and probably most significantly inflation at this point. We thought we'd take a minute, Daniel and I, to talk through this a little bit, really talk about inflation in general and what the likely impact would be to your portfolios, and maybe put it in better context.
So inflation is really just a general rise in prices of goods sold due to increase in raw material costs and labor costs. Energy has been on a rise over the past several quarters to historic highs that it is today. And energy is one of the primary cost factors in manufacturing goods sold due to transportation. The other is labor costs, and labor costs, while they are dramatically rising as well, they're not quite outpacing inflation. So another question that you guys may be asking yourself is, how is this time different? So if we look back to the prior time that we had rising inflation, we're going all the way back to the early 1980s. During that time, the Fed actually raised rates so dramatically, they deliberately put the U.S. economy into a recession to fight the superinflation. During that time, when that began, the interest rates were around 10%. So if we look today to see the difference, in the beginning of 2022, interest rates were around 3%. So to put that in context, if we look at the 0.5% raise that the Fed did earlier this year, as it compares to where we stand at the beginning of the year, we're looking at roughly a 17% increase in interest rates. If we compare that to 1980, we're only looking at a 5% increase. So it's a pretty dramatic difference if you look at it from that perspective. Also, hypothetically, if the Fed ended up raising rates to a 2% mark before the end of the year, that would be a nearly 67% increase in interest rates from where they stood at the beginning of 2022. Whereas in 1980, it's only 20%. So that's one of the problems that we're having. The other problem is we have a supply chain issue. So right now, manufacturers can't get the goods they need to create the product to sell. In a time where we do have a lot of dollars chasing too few goods, so you're getting rising cost of manufacture plus a general increase in the product itself due to the circumstances we are on the market. Now, that is having impact to the stock prices. So John, why don't you explain to us what's going on with regards to stock prices due to this inflation?
That's kind of pretty interesting stuff, and I think bears some analysis. I think it's intuitive on all our parts that if interest rates go up, it could have initially at least a negative impact on the stock market. A lot of that is just because there's a discomfort level, number one. But number two, there's going to be X amount of individual investors that are going to elect to take some profits off the table, if you will, especially following a couple of better years in the stock market, and cash in some of those stocks. That has the immediate impact of having stock prices potentially go lower in and of itself. So your first reaction to this might be, well, if it's that easy, stock prices are going down because interest rates are going up, why are we even in the market? Not so fast there, because what we historically have seen, if we look back at the last 5 rising interest rate cycles, only in one of those cycles has the leading indices gone down in any case. So now and sometimes they've gone up rather substantially. Now understand that is not a short-term deal. We're talking about the entire cycle of interest rate rises, which varies from relatively short periods to sometimes very longer periods. Conversely, on the short term, if we look at this on the short term, and we just did an analysis of looking a month out after the Fed announces a rate hike, very immediate reactions. It's pretty 50-50 on that. The stock market goes up half the time, goes down the other half of the time. But isn't that what we always expect in short-term issues. Regardless of the fact that we have a rising interest rate environment, short-term, the market is always unpredictable. Longer-term, maybe more predictable. And that seems to be the case here as well. I guess our message, at least on the stock market part of this, is maybe don't overreact to it too much, because historically the stock market can handle rising interest rate environments. Fortunately, working with us gives you some other insulation as well. And that's where the planning process that we're espousing for our clients comes into play. So let's talk for a minute, since Daniel's doing the heavy lifting on the planning, and how the planning can actually have a positive impact on our outcome here.
So with regards to the planning, remember that's what's driving your portfolio. That's what's driving the allocation. So with that in mind, we purposely build our allocations with downturns in mind, because they do happen. So we stress test them to see what happens with actual market returns in those good years and the bad years. While it's happening, like right now, it can be a bit uncomfortable, but you can rest assured it's been well thought out and you're positioned for the long term. So the next question you may be asking is, how long will this last? Well, to be honest, that's uncertain. Until we get the high inflation under control and supply chain issues curtailed, this could continue. But should you invest or continue to invest in a market like this? Historically, markets have always recovered. And while that's no guarantee, it does appear that we're on a road to recovery. One of the things that's positive out of this is the fact that technically just about all asset classes are down, which presents a buying opportunity for the long-term investor, which is where the planning comes into play. So we would encourage you on an individual basis to have a conversation with us to determine if any allocation changes should be made, should we be doing anything different with your plan. Remember, we are here for you. Just let us know and we'll sit down and have a conversation.